A rigid structure projects the illusion of total stability, right up until the exact moment it shatters. When external pressure shifts, absolute size becomes a liability, and survival depends entirely on the ability to adapt. This data visualization shows the historical divide in money management. On the left, the traditional 1950s mutual fund, a conservative growth line relying on the slow upward drift of the broader economy. On the right, the return stream of modern alternative funds, volatile, detached from general economic conditions, and compounding at an exponential rate. Academic finance insists this right-hand curve should not exist. According to the efficient market hypothesis, all available information is instantly priced into a stock. If the market is perfectly efficient, consistently beating the average by a wide margin is a mathematical impossibility. The architect who exposed the flaw in that academic theory was not a banker. Alfred Winslow Jones was a sociologist and a former diplomat who spent his youth studying at a Marxist school in Berlin and running missions for an anti-Nazi resistance group. In 1949, Jones designed a completely new financial vehicle. He engineered a portfolio specifically structured to strip away the background noise of the general market, isolating pure individual stock-picking skill. He called it a hedged fund. The mathematical blueprint Jones drafted in a small Broad Street office set off a chain reaction in global finance, evolving over 60 years from an obscure private partnership into an industry managing trillions of dollars by the 2008 financial crisis. Tracing the evolution of that specific architecture reveals a stark reality about systemic risk. It explains why the heavily regulated, government-backed banking sector collapsed the global economy, while a network of fiercely unregulated, highly leveraged private funds survived. The traditional Wall Street trustee avoided leverage and short selling, viewing them as tools for reckless speculation. Jones realized that by pairing these tools together, he could deploy speculative mechanics to achieve strictly conservative ends. This scenario from a 1961 prospectus outlines the advantage. Consider two investors with $100,000 in capital. The traditional investor buys $80,000 in stocks and keeps $20,000 in safe bonds. The hedged investor borrows an additional $100,000, doubling their purchasing power to $200,000. With that expanded war chest, the hedged investor buys $130,000 of promising stocks and short sells $70,000 of poorly run companies. Because the $70,000 in shorts cancels out $70,000 of the longs, the hedged portfolio has a net market exposure of only $60,000, $20,000 less than the traditional investor. If the broader market rises 20%, the hedged investor's long positions generate significant gains, amplified by the leverage. The short positions lose money, but because the portfolio contains superior stocks, the net profit totals $32,000. The traditional investor earns only $24,000. The true defense mechanism triggers in a bear market. If the overall market drops 20%, the traditional investor loses $8,000. But the hedged investor's $70,000 short position turns highly profitable, cushioning the blow to their long positions. The hedged portfolio actually earns $8,000 while the market crashes. Jones recognized that a perfect hedge required deeper math than simply matching dollar amounts. He calculated the historical price swings of thousands of individual equities relative to the S&P 500, a measurement he called velocity. If a portfolio held a short position in a highly volatile stock, holding an equal dollar amount in a slow-moving utility stock would not provide adequate protection. Maintaining strict market neutrality required carefully weighting the velocity of every position. By balancing longs and shorts against volatility, Jones decoupled his returns from the overall direction of the market. He isolated the exact premium generated purely by analytical skill. He engineered the architecture of alpha. By the 1970s, the financial ecosystem shifted. Individual retail investors were replaced by massive institutional pension funds, executing block trades of 100,000 shares at a time. The academic theory of market efficiency relies on the assumption of perfect liquidity, that you can always buy or sell an asset instantly at its true price. But a massive pension fund trying to offload stock rapidly creates a physical choke point, driving the price down simply through the sheer volume of the transaction. Michael Steinhardt identified this structural friction. He utilized his fund's agile capital to act as an immediate liquidity provider for these institutions, absorbing the massive block trades at a steep discount and then selling them off into the open market for a guaranteed premium. At the same time, a group in New Jersey called Commodities Corporation was testing the limits of data. They built complex mathematical models to predict crop prices based on global supply and demand, but they nearly bankrupted the firm when their models failed to process a sudden market panic over corn blight. Surviving that near-death experience forced a total pivot. The firm abandoned the analysis of weather patterns and crop yields, turning instead to early computer programs designed exclusively to track and follow momentum trends in price data. They realized that academic models assumed rational actors, but real markets were driven by crowd psychology. A rising price generates optimism, which triggers more buying, creating an aggressive, mechanical feedback loop. These early funds prove that market efficiency was often an illusion. Mechanical volume constraints and behavioral momentum routinely distorted asset prices, creating highly profitable opportunities for those operating outside the traditional rules. The next evolution of the industry scaled the battlefield up. Macro trading moved beyond individual corporate balance sheets to betting directly on the monetary policies and interest rates of sovereign nations. George Soros rejected the core premise of classical finance entirely. He did not believe that markets passively reflected an objective, underlying economic reality. This is Soros's theory of reflexivity. Investors are not just observers, they are active participants. A bullish perception directly improves a company's ability to hire and raise cash, manufacturing the very success investors originally predicted. The perception creates the reality. Applying this framework to the US dollar in 1985, Soros observed a currency pushed far from equilibrium by pure speculative momentum. He built a massive short position, absorbing heavy early losses. When the Plaza Accord announced global intervention to push the dollar down, it broke the market's bias. Soros aggressively doubled his position and cleared a $230 million profit. By 1992, Soros and his lead trader Stanley Druckenmiller identified a structural rigidity in the European exchange rate mechanism. They calculated that the Bank of England lacked the reserves to artificially prop up the pound, and their massive $10 billion short position forced the government to abandon its currency peg in a single day. Paul Tudor Jones took a different route to macro dominance. Rather than philosophical theories, Jones treated the market as a high-speed study in crowd panic. By mapping the historical price charts of the 1920s onto the 1980s, he accurately timed the massive Black Monday crash of 1987. The critical counterweight to taking massive macro positions is an obsessive, paranoid focus on capital preservation. Jones employed independent risk managers with the authority to overrule his own trades, enforcing the rule that staying solvent matters more than being right on a single call. With these trades, Soros and Jones elevated hedge funds from stock-picking vehicles into geopolitical forces capable of breaking the monetary policies of central banks. Even brilliant analysis cannot survive poor structural timing. Julian Robertson built Tiger Management into a powerhouse by adhering to fundamental value investing, going long on highly profitable companies and shorting the worst-run businesses. But in the late 1990s, the dot-com bubble discarded valuation entirely. Robertson refused to buy into companies with zero revenue and suffered massive losses as the market kept climbing. He was forced to liquidate his fund in March 2000, mere weeks before the bubble finally burst. The market had remained irrational longer than his investors allowed him to stay solvent. In the mid-2000s, an unassuming merger arbitrage manager named John Paulson went looking for the next credit bubble. He bypassed the tech sector and meticulously searched the documentation of the subprime housing market. Paulson was seeking the perfect asymmetrical bet, a financial position where the cost of entry and potential losses are strictly limited, but the potential payout scales exponentially. This model represents a mortgage-backed security, a pyramid of debt built by Wall Street. Paulson identified a catastrophic structural weakness in the bottom layer, the BBB-rated tranche. It contained the riskiest loans and constituted only about 1% of the total structure. Because of how the debt was sliced, If just 6% of the underlying mortgages in the pool defaulted, the entire BBB layer would be wiped out. The bond would go to zero. You cannot short an actual house. Instead, Paulson bought an insurance policy called a credit default swap. If the mortgages held, he lost a manageable fraction of his capital. But if the bonds went to zero, the contracts obligated the banks to pay out 100 times his initial investment. By the end of 2007, Paulson's firm cleared $15 billion in profit. He achieved this scale by isolating a flaw in the documentation of mortgage bonds that the ratings agencies and major banks had systematically ignored. Paulson's personal earnings of $4 billion that year were nearly 80 times the record-breaking bonus awarded to the CEO of Goldman Sachs. This result elevated his architectural bet against the housing market into a class of profit that no traditional bank executive had ever achieved. In the immediate aftermath of the 2008 crash, public anger quickly synthesized a narrative. Reckless speculators took massive risks and destroyed the global economy. But this comparison of systemic architecture tells a different story. On the left is a traditional investment bank, routinely operating at 30-to-1 leverage. On the right is a network of independent hedge funds, typically operating at just 2-to-1 leverage. The bank structure generates moral hazard. Because it holds taxpayer deposits and has access to emergency Federal Reserve lending, executives know they operate with a government safety net. They can privatize all the profits of extreme leverage, knowing the state will absorb the losses. Conversely, the hedge fund operates under a mandate of structural paranoia. They mark their portfolios to market daily and have strict high watermarks, meaning managers earn no performance fees until they recoup past losses. And most crucially, there is absolutely no taxpayer backstop. When a severe macroeconomic shock strikes both architectures simultaneously, the consequences diverge immediately. The over-leveraged bank shatters. Because its failure threatens the basic function of the broader economy, it triggers a catastrophic crisis, forcing a massive injection of public tax dollars to keep the doors open. When a shock hits the hedge fund network, individual funds suffer extreme losses and liquidate. The managers lose their capital and reputation, but the failure is isolated. Surviving funds quickly absorb the liquidated assets. The individual firm dies, but the systemic network remains stable, requiring zero public capital. History demonstrates this clearly. When long-term capital management collapsed in 1998 and Amaranth Advisors blew up in 2006, investors lost billions. But the firms were small enough to fail. Their liquidation did not freeze global credit or require congressional intervention. Capitalism requires the rigid enforcement of consequences. Systemic resilience is built not by sheltering institutions from failure, but by maintaining a network of agile actors forced to manage risk with severe paranoia. The entities shielded from that threat by public money are the actual danger to the global economy.